All right, welcome. 2021 real estate market forecast continues, and getting through a little technical difficulties. I really want to thank Bruce Norris with the Norris Group. I think his introduction to pretty much everybody on this on our 2021 market forecast, he goes without an introduction. But the Norris Group, hard money lender, respected investor, just as known, at least for me, in his market timing events that he's been doing every year. As he is for his investing and hard money lending. Recently started to do some investing and moving out to Florida. So, by the way, Bruce, just to reset the audience, I think it's been a year. We missed you last year because you were doing one of your boot camps out in Florida. But in prior years, it's basically the same audience that we're talking to. I don't know whether we're going to have 600 or 2,000, but we're going to have more people than ever that are going to see this. Most of them are industry types. So you got some realtors and mortgage guys, affiliates. We're still doing a huge amount of property management in the Inland Empire. So I would imagine those landlords that still own property in the Inland Empire are going to be very interested in what you not only have to say, but what you've actually done, because some of them may not be aware that you've and I don't want to miscategorize it, but that you've exited the Southern California real estate market for Florida. So basically that's the same audience. So again, welcome. How the heck are you?
I'm great. I'm dressed as a Floridian too.
Nice. Well, we wouldn't have it any other way. So let me set it up this way. I believe you called me a couple of months ago, and I don't even know what you were calling about, but we stumbled onto a conversation about, oh my gosh, who would have thought? What's going on? And in the lead up to our interview just a few minutes ago, while we were getting the technical stuff squared away, I had kind of mentioned you're almost the last person that we're interviewing for this year's forecast. I've heard all of Christopher Thornburg, several other economists, several other people have an opinion on why we had such a great year. And I got to tell you, after listening to all of them, I'm still confused. I'm still puzzled as to what happened, at least from a standpoint of consumer confidence, demand, et cetera, et cetera. Like I told you earlier, I listened to Doug Duncan, the Fannie Mae economist, your podcast that you recently did with him. I listened to it twice, and I listened to it this morning. He had some insight. So let's start with that, and then we'll go wherever you want to go. So what do you have to say about the last 12 months and what we've seen in our real estate world?
I think to answer it properly, I'm going to go back to 2019, because 2019 for the entirety of the year had the best set of charts that I've ever seen. So the lowest unemployment in 50 years, very high affordability in relationship to California's history, no big inventory, and also no foreclosures in the marketplace. You have those combinations, you typically have a 15% price run, and we probably had a 3 or 4% price run, with all of those things that were as good as I've ever seen it, if not better. So That was 2019. So going into 2020, we also had something called what we thought was certainty. So the market was going to do, again, what it did in 2019, and then the coronavirus hits. And so my initial reaction would be to go, okay, this is going to be a problem. And then about a month and a half after it started, all of a sudden, from June, July till the end of the year, real estate exploded in price. And I really had to think about that. Okay. And I came up with a phrase: urgency trumped certainty.
Urgency.
And I think there were, okay. I think there were two groups that played a part in that. There was a group that said, okay, my house is listed and now it's not listed. No one's going to tour my house right now. So I'm pulling my listing. So 50% approximately of the listings disappeared overnight. But on the other side, you had an urgent buyer come out and say, okay, I've got to get out of whatever circumstance I'm living in, whether it's I'm in a high rise or I'm in a city that's not favorable to what I want now. And so all of a sudden you had the urgent buyer show up where volume goes up by 20% or more and lands on inventory that's 50% less. Well, that's a formula for price increases, and that's what we had. But urgency trumped certainties. 2019, we had a certain market. We kind of expected things to continue. And then when it all got topsy-turvy, who would have expected real estate to explode in value and volume? But that's exactly what happened.
Yeah, it sure did. But so even with, okay, so I like it. I like the urgency and the certainty. But again, I guess the reality was it doesn't really matter if it makes sense to me. I just could not figure out why there was so much certainty in individual employment. And I think
no, that's what I'm saying. That was fine in 2019.
We're still in 19. Okay, all right.
No, that's what I'm saying. Certainty was in place all of 2019.
Right.
Then you get to 2020, and none of that's certain.
Right.
It's uncertain, and now. But what was more important than uncertainty, maybe that's a better way to put it, is urgency.
Okay.
So, yeah, there wasn't anything that you could look at and say, oh, I feel very comfortable with 2020. Nothing like that.
But why would I buy a house? Why would I buy a house in April, May, or June of last year in COVID? Which, by the way, people did, and they bought them in record numbers, and we had a record-setting year, with the exception of a little blip in March and the first week of April. But what was that? Why was there the confidence, or I guess the urgency, maybe is what you're saying? The interest rates or
Well, to me, of course, interest rates they're at their under 3%, probably the first time ever. But as far as affordability, it was still in the range of very affordable.
Right.
So it might have played a little bit of a factor, but I think the urgency was I've got to get out of my living situation. I have to get out of being a renter, or I have to come from an area that's too crowded or vertical. I think all those things played a role, but it landed on almost a 50% reduction in inventory.
Right.
So demand, just the numbers will give you a price increase.
Right.
Kick demand up over 20% and landed on half the inventory. Okay. You're going to have a price increase.
Right. Well, we're going to need to see some charts. I can't wait till you put together some charts on this stuff that I can look at and fall asleep to at night. And I don't mean fall asleep as in I'm bored. I'll be looking at them so long. I'll just gloss over. Next thing you know, it'll be 2:00 in the morning, which is what I've done with your timing events. You put out your 500-page booklet, and I just absorb that. I'm just one of those guys. Okay, so
but I'm going to answer your question though.
Okay.
The answer doesn't lie in charts.
Okay.
Because 2019 was the year that had the favorable charts and the favorable mood and the certainty. So you don't have an urgency chart, but you had an urgent reaction.
Yeah, but how does that plug into your? What do you still have your mood? What do you call it? The mood meter? Or what do you call that thing?
The moodometer. All it does is track the percentage of income people are forced to pay at the peak of a market. It doesn't mean they pay it, but it's collectively it gets to this big number. We're nowhere close to that, but we were nowhere close to it in 2019.
Right. Okay.
So I think that's what you have to do. You have to go to what was different. So there wasn't anything more favorable in 2020, statistically wise. No. It was much less certain. But I think the only thing I could figure it out was people got urgent about making a decision to own something and where they were going to go.
Right. Okay. Well, I don't know. I'm still scratching my head, and that's not that your answer doesn't make any sense, but I'll give you where I was. I think we all had the collective panic attack in whatever that was, March 15th, March 18th, whatever it was, when we went into you talk about unprecedented, stay-at-home orders. It was crazy. Now, you were in Florida at that time, right? So I'm assuming you guys were doing the same thing. But in Riverside, good Lord, I'd go to the Canyon Crest Town Center where you and I, I still live, you used to live near, and it was crazy empty, scary. So at any rate, we have a little bit of a panic attack, which left me within 3 weeks, because by the first week of April, second week of April at the latest, things were hopping. It was obvious, oh my gosh, okay, well, I guess we're going to make it through this. Now, again, if you're in the restaurant business or the entertainment business, my buddy or at least was connected with the promotion of the Coachella Music Festival and Stagecoach, and needless to say, that world has changed dramatically. But as far as real estate was concerned, it's just It just changed everything. So you had mentioned inventory. I know you're in Florida. Are you following what's going on here in Southern California with these record low sub 30-day? I think right now, quite honestly, I think most of the Inland Empire has less than a 15-day standing inventory. Is that happening in Florida where you're at as well? And what do you think about all that?
Yeah, very, very aggressive prices increasing, very low inventory. We're building new homes. So if we break ground, we have people driving by saying we'll buy it. And we're saying, no, we don't want to sell it. So we wait until we're done to sell it, and then it sells in a day.
Right.
So that's the market. It's probably not any different than California. It's just on fire.
Right.
So what's interesting is Florida has a migration, has a huge amount of migration, where California actually has pretty huge amount of people leaving.
Yep.
And you still have the same result for right now. So
yeah,
that's interesting to me too.
Well, yeah, they're leaving, but that's okay. I mean, it's not okay, but because the standard inventory is so low, and it's so funny because no, go ahead.
I wanted to say something that this is applicable. Typically at a boom market, so you look at the construction of new homes, you're usually at 140,000 single-family homes.
Okay.
So a boom year in sales is approaching 500,000, but 140 of those will be taken up by new homes.
Okay.
Well, now you have approaching, let's say, upwards of 460, 480, but your new single-family builds for all of 2020, 56,000.
Right.
So all of that demand couldn't land on new homes. It had to land on existing inventory.
Right.
And something else significant did happen in December. What happened was your prices for existing homes inverted with new home prices.
Yep.
It went higher.
Yep.
And it's done that in 80, 89, 05, and this December. That's the only 4 times it's ever happened.
Okay, and what conclusion can we draw from that? What happened there is a chart for that, obviously.
Yeah.
So what does that mean?
Well, it's one of the comps we use. So we have 6 comps that we look at historically and say when all of them are in agreement, then you have an appraisal. In other words, the state of California is done if they all what I call mature. So the new house being the existing home, that's a mature comp that says you're closing in at the end of the market, but the affordability number is still in the 20s and pretty well still mid-20s. You haven't got the 3% mortgage rate calculated in there yet.
Right.
But it's still got historical room. So you still have room. You have one comp that's matured, and you have other comps that have not. So I don't think anything negative is going to happen in 2021 to California real estate. I do not see that.
Interesting.
Yeah,
okay.
The other thing, Lance, I'm sorry to cut you off.
No, go ahead.
The other thing is, and what's your take? You're a realtor. Pay attention to people that are behind in payments, let's say right now, for forbearance. My take is that those are not going to convert into foreclosures in any large number.
Correct.
And we've never had a price decline unless you have a market that's dominated by foreclosure.
Yeah, and it's been a theme throughout our forecast, and we have several speakers that we talked about the forbearance issues. I completely agree with you, and I know there's people that disagree, and the people that disagree, I'm like, well, just show me the data as to why these forbearances are going to ultimately turn into REO, and I just. There's nothing to me that indicates on any significant level that's going to happen for all the obvious reasons. More than likely these people have owned the property for a while. More than likely they got a traditional loan which was qualified, and not to mention, I mean, you mentioned some appreciation numbers. Again, you throw out percentages. You can always someone say you're off by a point or two, but Riverside County year over year, the number I pulled up was around a 20% appreciation rate. Same thing with San Bernardino County. Same thing with LA Orange. I mean, you're looking at somewhere between 18 and 22, 23% appreciation rate across the board. So given that, Now, again, that's the one thing. It's been a theme with this forecast, because in some ways, as real estate practitioners, we've been almost giddy coming out of 2020 and saying, "Oh my gosh, we dodged a bullet with COVID," and I always stop and pause and say, "Well, wait a minute. There's a lot of people that did not dodge that bullet." Maybe that's a bad analogy, but one of my very best friends is in the entertainment business. Well, he's had some difficulty, needless to say. Another friend is owns a restaurant. He's certainly had some challenging times. Barry O'Connor, our mutual, I don't know how well if you ever used him, but he speaks in on our panel. Who would have thought, Bruce, I would have an eviction attorney speaking at our market forecast? Why in the world would I do that? Well, it's the flip side of the forbearance, which is the eviction moratorium. So to answer the question on the forbearance in relation to foreclosures, I don't see it. I just don't see any chance of that for all the obvious reasons, and we've already talked about. Yep, go ahead.
Let me just add, having a property go to foreclosure is not necessarily, doesn't end up as an REO. What you're saying is, just in the last year, we have a 20% gain in equity.
Yep.
But prior to that, we had a series of years where it only went up for probably, 6 or 7 years. So people have huge amounts of equity. When that went to sale, it was going to get bought. It won't become an REO by and large.
Correct.
The large percentage would be bought by somebody that was going to either fix it and then retail it at full price, or it was going to be kept as a rental. Right. So it doesn't interfere with the comps. That's what happens. In 2009, 80% of the Inland Empire was comps of REOs that were 75% off of retail. Yeah,
there's a chart for that too. Oh. Well, but to that point, when you say go to sale, though, I want to make sure let's define sale. You mean some of these properties ultimately go to trustee sale and be picked up by investors?
Yeah.
But why would they even do that? I mean, that, again, as a guy who has cut his teeth on REO and on your side of the fence has made a career out of acquiring properties that are distressed. But let's face it. I mean, the vast majority of those owners should never end up on a courthouse steps. They should talk to us on the sales side. So come to us. Now, but again, some of them fall through the cracks for whatever reason, and those are business opportunity for investors like yourself and that follow you. To I'm sure they're all keeping an eye on them, and there'll be some opportunity there. But you're right. They're never going to end up in a Fannie Mae portfolio.
No.
So let's, because I don't want to monopolize your time too much, because I could go forever with you. There's at least a few other things I want to talk about. So just really briefly on the eviction side, because obviously you have had rentals forever. What's your take on the eviction moratoriums? But let me set the stage, and I'll poison the well a little bit for you. We manage hundreds and hundreds and hundreds of properties in the Inland Empire. Our delinquency rate, and again, we're mostly single family, and I think you touched on this with Doug Duncan. Our delinquency rate is actually less coming out of 2020 than it was going into. So in other words, we've seen really no impact. Now we do have, and again, I'm going to have some people in my audience that are my clients that are watching this right now, and they're going to probably screaming at their computer screen right now because they happen to be one of those landlords who has a non-performing tenant, and they maybe haven't collected rent in 10 months. So, but on balance, what are you seeing in that market? And then I want to make sure we save time, because I want to make sure that the exiting California is still where your head is, and I want to talk about Florida. But let's talk about the tenant delinquency and what, if anything, we need to look at on that.
I think you're right. I don't think the majority of people that have renters have delinquencies in any great number. So I don't. And people that I know that manage properties like yourself, Mike O'Neill, and you've just borne out the same statistics. They don't have excessive late payers. In Florida, definitely have the same thing. Almost everybody has a pretty normal number of delinquencies. The idea that people were going to abuse it, not pay it, because if they had a chance, it didn't turn out to be true. When the coronavirus first hit, I made a call to my property manager, and I said, if we have somebody that's legitimately lost their job or their business is, restaurant or something, let's just work with him. I mean, I told him that directly because I think, of course, that's what lawyers do is they take precedent and say, well, we're going to handle that for you. But I think by and large, investors would probably have already done that. They would go, okay, I get it. The guy can't open his restaurant.
Right.
So we'll work with them.
Yeah, and I think that pretty much was the case across the board. Okay, all right. So I want to make sure we save some time. So I don't talk to you maybe as much as I did before, so I certainly don't want to assume anything. Are you at all invested in Southern California real estate, or are you advising anybody to invest in Southern California real estate from just a pure investment, single family rental basis, but at all? So my understanding is you said I've called the market, I'm out. Is that still the case?
Well, I've made personal decisions. That's not calling the market out. There's people that will always keep their money in California real estate, and California real estate is having a much better year or had a much better year in 2020 than I would have envisioned. So right. I did not get that correct because I thought because of 2019 not going anywhere, I thought 2020 would have a problem, and it didn't even have a problem with coronavirus. That doesn't change what I wanted to do personally.
Right.
So the reason I left California is I got concerned about how rules were being made that I thought I never even got a say-so. I didn't get to vote. If I did vote, the same thing that I voted against became law a year later. So,
right.
Yeah, those things concerned me.
Yep.
That's why I'm in Florida.
Yep. Okay. Well, I'll say so. I get it. So let's stay. And I don't mean to put you in that spot. And I appreciate that answer.
Doesn't bother me.
So, but let's talk about what you're doing in Florida. So you've been there for what have we? I know you've probably been there for years and years and years. But as far as the new project and the stuff that you're building, what are you 2 years into that now, or where are you?
Well, personally, I moved a fair amount of stuff into Florida about 4 years ago.
Okay.
Interviewing Doug Duncan actually kicked it off. I was interviewing him in 2015. And to prepare for that, I read the Fannie Mae financials for 2014. And in that, it said that 25% of Fannie Mae's losses came from one state, Florida.
Right.
And so I got a smile on my face because I realized what that meant. And I was also confused. 2015, California was already healing,
right,
and already doing well for 3 or 4 years. So I looked up why that was, and Florida had a 4-year foreclosure process. So
right.
It literally was still in 2011.
Right.
So I called to my buddy and I said, let's buy a tract of building lots somebody can't build on. And that's what I did. And we built the rentals. And so that's how long I've been with rental properties.
So how many units have
Florida.
How many units have you built to date?
With other builders, for other people, we're probably 100 or so.
Wow.
So that's something that's kind of growing in interest.
That's exciting.
And we're also flipping houses. One thing I wanted to talk to you about, matter of fact, bat it around a little bit, because when I interviewed Doug Duncan just a couple weeks ago, and you said you listened to it a couple times, one of the things that he said, and one of their projections, I just had to do a double take on, a 6.5% GDP growth.
Right. Yep.
They come out with a 3-year projection every year in January. So in 2020, before the coronavirus, their projection for 2021 was 2%. Now we go through the coronavirus. A year later, their projection for the same, now 2021, is 6.5%. And I just didn't comprehend that. That was really hard for me to think about. So, yeah, there's a chart for this, too. You go back and say, okay, when did we have 6.5% GDP growth or bigger? 1984. What was interest rates? Fed fund rate 10, mortgage rates 12. And so then I did ask him during the interview, okay, well, what do you feel like the Fed fund rate's going to be? I think that was on air. And or either that or their projection was it was going to be 0 to 0.25%. So we have never had this scenario, ever.
Right, which is basically unchanged, the Fed funds, the 0 to 0.25. So
that's right. You got a 0 to 0.25 Fed fund rate with a 6%, 6.5% GDP projection. That's never existed.
I wonder what it would have been. By the way, that interview with Doug, just real quick, again, a commercial for Bruce. If you want more information on Bruce, thenorrisgroup.com, all the Florida stuff is there. You can reach out to his team on that. The podcasts also are there. So if you want to hear that Doug Duncan interview that we're talking about, go to Bruce's website, thenorrisgroup.com, hit the podcast section. It's there. Boom. You don't have to subscribe or anything. You're in. But that podcast was prior to the $1.9 trillion package passing. So
that's right.
Now it was granted you guys were even talking about, would it pass and what impact that would have during the interview. So it wasn't, I don't think Doug was in a vacuum or you were in a vacuum when you were having that conversation. So what does that do to the 6 or 6.5? Or is that what it is? Was that just kind of built in and said, hey, we're going to have all this money floating around. We already have just I don't know what it is. You probably know the amount of money that's sitting in people's savings accounts and sitting in banks right now doing nothing. So what does that mean, though? So given what you just said, and I'm not going to spit it out or regurgitate it because I'll get it wrong. What does that mean? What does that mean to you for 2021, 2022, the future? What are you drawing from that?
I had a hard time buying it. I really respect him, and it's the nationally produced document, so you're sort of stuck with it. That's one thing I've learned about putting things in writing. Okay, there it is. That's what you said. So, but because I respect him, I really had to recalibrate what I thought, because 6.5% GDP growth, the sectors that we lost a lot of GDP growth, you can't make up. Like the guy that opens the restaurant, you can't go eat twice tonight.
Right. Well, I could.
You can't go on. Yeah, you can't go on 2 cruises next week,
right?
Or get 2 haircuts. So how does that sector make up for lost ground? I don't see that it does. It just lost.
Right.
So that's why I'm really shocked at the GDP growth. So,
but maybe it does, Bruce. Maybe if I normally go on 1 cruise a year and I eat out, a couple of times a month or a week, depending upon my budget. Maybe I'm just so excited and I've taken those things for granted in the past, that this year, and I've got a little bit of extra money for whatever reason. My employment was stable, or maybe I got stimulus funds, who knows. So maybe I do take 2 cruises this year, and then maybe I'd go to dinner twice as many times a month as I did before. Is that reasonable, or am I missing it?
I think it must be a blend of maybe a little bit more of that. You can't go say I'm going to get 2 haircuts this week.
Well, maybe
so there'll be some sectors will just have a normal year instead of a bad year. Maybe they'll have more people say, I got to get out. You're right. That could be. I don't know. I don't have an answer for that. I do know that we have never had a 6.5 GDP year with the interest rates we have. So, then you start talking about, okay, well, what's the likelihood of inflation? And
pretty good,
See, I don't think it is. See, I know you're supposed to have that, but I just think there's bigger things that will take precedent over that. Okay, right. So you have things like AI and robotics and aging of a population that are typically deflationary, not inflationary. So you have those big factors kind of weighing it down. So I'm not saying Doug Duncan is wrong. I'm just having a hard time comprehending it.
Right.
And so John Burns, I get to interview him. Now, what's fun about interviewing next week John Burns is, so he's got clients that are the national builders and hedge funds. So there's like the brightest people in the room. So they're asking him for advice, but he also gets to know what they're doing.
Right.
What they're thinking. So I'm pretty fascinated with that interview too, because what they're thinking the demand is going to be going forward. Because right now, one of the things that we've got real challenges with when you build houses is the cost of things has accelerated so quickly.
Just the building materials and the accessibility. Is that just... How are you doing with that, by the way? Are you having challenges getting lumber, and is the cost becoming prohibitive? Or maybe it's not lumber. I'm not into that, but is it lumber? Is it electronics? Is it labor? Is that a problem?
It's all a problem. Electronics, especially right around the coronavirus, when you were trying to finish up your house and put in appliances, getting a match set of appliances was not easy.
Yeah, I actually.
Lumber.
Oh, go ahead.
Lumber's gone up an awful lot. Okay, but see, what's interesting about some of the studies that I've done is that there's a report by Cal Poly Pomona, and what they did during the 70s, where they actually charted the cost of a house per contractor, if you will. So they like, here, build this house and bid it out per part. So the plumber would do his parts and the labor, and the electrician do the same thing, and the general contractor would compile all these things. But you would see all these little categories as it progressed through the inflation years of the 70s. And it dawned on me, when we own a house, we own a basket of commodities. And then there's a correlation between a new house cost and an existing house cost.
Right.
And at the very peak of a market, the existing homes become more expensive than the new ones.
Right.
That means your basket of commodities kept up with the new stuff, and you made money just sitting there because you own the concrete and the wood that's in that house, oddly enough. Yeah. So going forward, that'll be an interesting question for John Burns, because there's a point, of course, that you reach maybe an affordability breaking point. But I know we're not there yet.
Yeah, well, again, 17 things I want to comment on in that, but I do want to direct everybody back to the Norris Group's website. Again, a large portion of my audience, quite honestly, comes to the forecast because maybe they don't get a chance to see you as often as, and I know there's a certain percentage of people that only watch my market forecast to hear you. So having said that, go to Bruce's website. We do our forecast once a year. I mean, you're interviewing people. How often do you do interviews, by the way? Is it weekly or a couple times a month, or what is it?
Once a week.
Okay, once a week. Okay, well, you got to go because Bruce does this. This is his job. I mean, and by the way, I know you don't like the economist title, and I know you're not, technically trained and educated as an economist, but I think to so many of us, you certainly have the credentials of an economist, and whether it's a Thornburg or I've got Manford. I'm not sure if you're familiar with Manford Keel. He's with Claremont McKenna College. He's going to be coming into the studio here right after we're done with you. But again, I don't know that anybody can work harder or study these numbers more than you do. So just real quick before we wrap up, you hit a spot with me with this appliance thing. I bought a house again. So I'm questioning why people are buying houses last year. Well, I have to look in the mirror because my wife and I, Julie and I, bought a house over the summer in Canyon Crest. We could walk to your old place from our new place, and
okay,
and. The house needed a little bit of work. It was a resale, and so we needed a refrigerator, and we needed a stove, and we needed a dishwasher. Oh my God, what an eye opener! What an eye opener! The lack of availability of, forget about matching appliances. Good Lord, Bruce, we waited months to get a dishwasher. Absolutely crazy. Just crazy times. And we kind of joked, and looking back, we joked about toilet paper and paper towels, right? Because you couldn't get any toilet paper and paper towels at the beginning of COVID. But as I started getting further into the year, there were a lot of other commodities that it was like, wow, this supply chain is broken. And again, if that's your industry, holy cow. How do you make that up? And is that even fixed? Do you have any comments on that? Is the supply chain for that type of stuff, is that fixed, or are we still digging out of that?
Well, that's going to be one of the questions I know I'll pose to John Burns, because he's kind of got his finger on the pulse. I know there were two large lumber suppliers that were closed for the majority of 2020.
Right. So
they're back online, but they have to, not only make up for what they would have created. Now you have this craziness. Florida right now is selling every 2 months in lots, building lots, what they do in a year typically.
Wow. Every 2 months. So that's going to, 6 times? Is that right?
6 times.
Six
Yep.
times. Wow. Craziness. Well, Bruce, first of all, I don't want to cut you off. Is there anything you wanted to get off your chest before we wrap this up, or?
Have you told the boat conversation?
I haven't. Okay.
To this? Yeah, let's talk about that because I thought that was a very
okay. So let me set the story, and you jump in, and because when did we have that conversation? Because that was a couple months ago. Okay, so,
it was maybe May or something.
Oh, okay. So we talked a couple months ago, and then we talked in May. Okay, here's the boat story, guys. And again, you kind of got to know me. This is why never turn to me for economic advice. You always want to turn to the professionals. Turn to Bruce, because I am truly a consumer, and a lot of my experience, of course, it does tie. I mean, we own 4 real estate offices. We have several hundred real estate agents. You know, we're in the property management. All I do is look at this stuff, but I don't look at it necessarily under the same lens that someone like a Bruce Norris or Chris Thornburg or whatever happens to look at it. So for years, and I'm going to get to the boat story in a second. For years, I truly, as part of my business plan, I would gauge what type of a year I had ahead of me based upon a couple of things. I like boating, so I go to Lake Powell and I go to Lake Havasu and I do all that sort of stuff, and I do it a lot. I also like off-roading, so off-roaders generally have motorcycles and dune buggies and RVs and that sort of stuff. So let's just use the boating since that's where Bruce is at. So if I would go to Lake Havasu and on the 4th of July, and the Channel and London Bridge and the Sandbar and all of those places were busy, it generally meant things were pretty good. And I would base that not just on the number of people that were there, I would base it on the type of boats they had. And this goes way back. I mean, I can go back and we can tie this into the 2006, 7, 8, 9, collapse, because I was at the Sandbar at the river in 2005, and there are people that have $150,000, $200,000 boats that worked as a bank teller at making minimum wage. Okay, so which told me something. And again, we can go on a totally different conversation on that. So I would gauge who's buying boats, what kind of boat do they have, expensive boats, inexpensive boats, volume, etc. So this is the deal. I'm in the market for a boat last year, pre-COVID. Inland Boat Center, it's right down the street from us here, Inland Empire, located in Paris, one of the largest used and new boat retailers in Southern California. I stop in, I know the owner, I just texted him today, by the way, go see James, and I go in there early March, and this place is packed with boats and packed with people. And, okay, fair enough. Then we get to COVID, whatever that date was, March 17th, 18th, we're in lockdown. Now, I wasn't supposed to leave, but I'm like, okay, well, I'm leaving. I'm in the market for a boat. Let me sneak out of my quarantine and let me go down to see if James is open. So I go down there, and he's behind his desk, and he is, you could just see it in his face. You could see it in his body language, and he is not in a good place, okay? We chat, and he says, Lance, basically every boat I had under contract just canceled this week. We have, hundreds. They probably had 700, 800 boats, maybe more, on their lot right there. He said, we were queued up for the single best year ever. I've got my entire world tied into this, and basically every one of my contracts is canceled. Nobody wants a boat. And I left there. I just felt horrible. And I felt even more horrible because I said, well, you know what, dude, I'm still going to buy a boat from you, but you got to give me a good deal. So I almost felt like I was a shark circling this wounded seal kind of a thing. So at any rate,
I'm going to remember that. I'm going to remember that when Arios comes back.
Oh, yes, you are. Yes, you are. So at any rate, so I leave there and I'm thinking, oh, man, I really feel bad for him. I'm like, oh, man, this is horrible. So that was the middle of March. So now it's April. Let's just call it April 15th. Let's just say it's a month later. We're still, again, guys, we're a month into the COVID. I don't know where we are with the lockdown, but, it wasn't 2 weeks and then we were out. It was 2 weeks and then, well, we need more time and we need more time. I'm still a little nervous, but honestly, this was one of the turning points for me. This was one of the turning points for me that I thought, everything's going to be okay, at least short term. So I go into the same shop, probably April 10th. So we're maybe in lockdown 3 weeks. I look at James. He is 180 degrees. Not only is he not sad and looks like he's about ready to jump off the roof, he looks beyond happy. He's walking with the spring in his step. I'm like, what's going on? He says, well, we were slow for about 2 weeks. He says, Lance, for the last 10 days, we're off the hook. I got all those boats back under contract. Everybody that canceled came back, and the demand is stronger than ever. I talked to him in May. Lance, this is April 2020. April 2020. Lance, April 2020 was the single best month we've ever had in the history of our company. And guess what? That continued all the way through the year. If you go to his shop right now, if you go to his website, Inland Boat Center, they have hundreds and hundreds and hundreds of boats for sale. I think they have 60 boats for sale right now, which quite honestly, in some ways, mirrors our real estate market. So
Yeah.
I told Bruce that story. None of it made sense to me. Now, some people would say, well, wait a minute, people, they could safely do RVing and they could safely take their family out on a boat. And okay, maybe that makes sense. But spending the money is the part that I was questioning. The boats aren't cheap. Right? I mean, well, even used boats. I mean, God, if you looked at you want to talk about an investment, not that I'm recommending this, but my God, no one buys a used boat for appreciation. I did buy a boat last year, by the way. I did. I bought a boat last year, used boat, because the new ones are ridiculous. Who buys a new boat? Guess what? The boat I bought last year, I can sell for 30% more than what I bought it for today. That's not normal. Okay.
No, that is not normal.
That is not normal. So that's my boat story. Now, as kind of.
Well, you know what?
Yeah.
Let's go back to that urgency word.
Okay.
Because maybe there was not only an urgency to get to safety, if you thought that with housing, but maybe there's an urgency to live.
Oh.
I never had a boat, and I always wanted one. Whatever, I'm just trying to think this out.
Yeah. Wow. Well, there you go. Maybe that's it. Maybe that's the mic drop moment for our forecast this year. I got to tell you, okay, you just made me pause for a second. Okay. Wow, I think
Now, why would you have 2020 be better than 2019? What did you add? You added uncertainty.
Right.
And I don't know, maybe it just played out where, okay, we're going to do what we've always wanted to do right now.
Right. Like, is there a chart for that, Bruce? Can we measure that? So anyway, so that's the boat story. And I got to tell you, man, as we're getting close to wrapping this up, maybe you're right. Maybe the urgency and maybe the demand side, maybe that relates to housing. Maybe that does relate to housing. Maybe buyers have sat out there and said, we haven't bought or we weren't sure if we were going to buy. We haven't even talked about millennials. That's a whole nother hour-long interview. Maybe it was like, hey, I want to buy a house, and maybe this is my only opportunity, my urgency to actually own that. And again, maybe if I'm going to be on lockdown, and if it's going to continue for an extended period of time, I want to do it in my home. I don't want to do it in a rental. I don't know. Or for that matter, I want to buy the nicer boat. So,
yeah.
Well, I'm going to have to think that one through. I think you put me back on my heels there a little bit. Okay, Bruce, you've been way too generous with your time. We started late. We had some technical problems, so I'm always in debt to you. So, again, thank you so much. I know you missed us last year, but short of last year, I'm pretty sure you've done every single one of these forecasts for us. And
my pleasure, too. Thanks for making me part of your group.
Yeah, well, you're family, and you're certainly part of the group. And, again, check out everything Bruce does. It's top shelf, just AAA quality on everything that they do. Oh, just real quick, we'll let you wrap up. And I know you kind of just did it, but we're still going to do I Survive Real Estate this year. You got it on the calendar? Are we going to try to do a live event if you can, or what do you think?
Yeah, if we can, I'm sure Aaron will do it live.
Okay.
But I don't know that we know we can or not.
Well, you might be right there in that time frame where maybe that's so. So, at any rate, thank you, Bruce. Appreciate you so much.
Lance.
Well, I'll see you at your boot camp.
Okay, Lance. Thanks a lot.
All right, you got it. Bye-bye.
Bye-bye.